Hi guys, welcome back. Today we're going to talk about a little known topic that I think we should all be more familiar with. Something called being your own bank. And there's a couple of ways to do this, obviously. Accumulate enough money to buy the stuff you want would be one, but that's a bit lame in the context of this video. What I'm going to talk about here is how to use life insurance to be able to lend yourself money without any sort of credit check. So there's two types of life insurance, permanent and term. So term insurance is usually based on a set year, so 30 to 65. It'll be much lower per premiums per month, and it's meant to cover, when you have young children, a house, and all your financial obligations. And should you pass away prematurely, then your family might be heavily destabilized. So term insurance is for that. It's cheap, but eventually it expires, and if you didn't die, which everybody hopes they didn't die, then all the money goes away. The insurer keeps it, and that's it. On the other side of that coin is a permanent insurance, which will cost you more. It has a fixed payout, but it's forever. So you pay you pay a higher premium per month, but it'll never expire on you. And eventually, there's quite a bit of, let's call it equity, built up in the premium, which you could actually sell back to the insurance company and take the cash out. Or you can go to a bank and say you want to open a line of credit, but use the equity in the insurance policy as your lien, as the guarantee that you'll pay. So usually you can open a line of credit for up to 80% of what's available in your permanent life insurance, and then you can just lend yourself money from your life insurance if you need. This is a great way to get around some of the credit issues. Obviously, you'll pay interest on the line of credit, but it's usually quite favorable compared to credit cards and stuff like that. And depending on what you're doing with this credit, if it's for businesses, then the interest might actually be a business deduction. So it's not all bad. So anyway, something to consider. I wish I'd have known this earlier, because obviously the sooner you start planning for these things, the more you can participate. The longer you have to participate in them, the more they're worth. So I wish I had known the two differences, because I've always had term insurance through employers and various other systems. But yeah, when you leave the employer, that insurance goes with it. Whatever premium was paid, also gone. Second, employer insurance, you usually don't go through a physical, which means on the backside of it, they will do a whole lot of investigation in your medical records and potentially find some way to disqualify you. Whereas when you're going for your own insurance, specifically permanent insurance, they will make you go through a physical check, and they may exclude certain things. If they find pre-existing conditions, they'll be excluded from the payout premiums. But that's okay. It's also meaning that it's a guaranteed payout on the other side. They will, or well, as guaranteed as you can get with an insurance company. Anyway, that's it. Thanks.